What if 2026 becomes the new 2008? It's a chilling thought that's keeping economists and investors up at night. The 2008 financial crisis was a watershed moment that shook the global economy to its core. But could we be on the brink of another catastrophic meltdown? Let us take a journey back to 2008 and explore if we're heading toward the same treacherous waters today. First, we'll break down what happened during that fateful year. Then we'll examine the warning signs that might be pointing to a potential 2026 crash. Picture this, it's 2008. And the world is about to witness one of the most devastating economic collapses in modern history. The housing market is in free fall, banks are teetering on the edge of insolvency, and panic is spreading like wildfire through Wall Street. But how did we get there? At the heart of the 2008 crisis was a perfect storm of risky lending practices. A housing bubble of epic proportions, and a financial system built on a house of cards. Banks were handing out subprime mortgages like candy on Halloween, allowing people with shaky credit to buy homes they couldn't afford. These loans were then bundled into complex financial instruments called collateralized debt. Obligations, or CDOs, sound complicated. That's because it was, and that complexity helped mask the true risks. As housing prices soared to dizzying heights, everyone thought they could get rich quick. But what goes up must come down, and when the bubble finally burst, it sent shockwaves through the entire financial system. The collapse of Lehman Brothers in September 2008 was like dropping a match into a powder keg. Suddenly, banks realized they were holding billions in toxic assets, and the whole system began to unravel. The impact was swift and brutal. The stock market plummeted, wiping out trillions in wealth almost overnight. Unemployment skyrocketed as businesses shuttered their doors, unable to weather the storm. A wave of foreclosures swept across the nation, leaving neighborhoods dotted with empty homes and shattered dreams. But here's the million-dollar question: are we seeing the same red flags today that preceded the 2008 meltdown? Let's examine the evidence. First up, global debt. It's exploding like a supernova, reaching levels that make the 2008 crisis look like a warm-up act. Governments, corporations, and individuals are all borrowing like there's no tomorrow. But what happens when the bill comes due? Next, we've got asset bubbles inflating faster than a hot air balloon. Stock markets are hitting record highs, while real estate prices in many areas are through the roof. Sound familiar? It should, because it's eerily reminiscent of the conditions that led to the 2008 crash. And let's not forget about geopolitical tensions. From trade wars to actual wars, the world is a powder keg of uncertainty. Any one of these flashpoints could be the spark that ignites a global economic inferno. So, what are the experts saying? Well, it's a mixed bag. Some top economists are sounding the alarm, warning that we're on an unsustainable path. Others argue that the lessons learned from 2008 have made the financial system more resilient. But here's the kicker: even the optimists admit that the risks are mounting. Now, let's paint a picture of what a 2026 crash might look like. Which sectors would be most vulnerable? Tech companies, once the darlings of Wall Street, could see their sky-high valuations come crashing back to earth. The real estate market, propped up by years of low interest rates, might face a reckoning as rates rise and buyers disappear. But could we see a domino effect like in 2008? Absolutely. In our interconnected global economy, a crisis in one sector or country can quickly spread like a financial contagion. Banks, still at the heart of the financial system, could once again find themselves in the eye of the storm. And what about cryptocurrencies? Some tout them as a potential safe haven in times of economic turmoil, but the jury is still out on whether Bitcoin and its digital brethren would weather a full-blown financial crisis or crumble under the pressure. So, how can you prepare for this potential economic earthquake? Diversification is key. Think of it as not putting all your eggs in one basket or all your money in one asset class. Gold has long been a traditional safe haven during turbulent times. Real estate, despite its risks, can provide a tangible asset and potential income stream. And yes, even cryptocurrencies might have a place in a well-balanced portfolio, but proceed with caution. Don't forget about good old-fashioned cash reserves, either. Having a financial cushion can help you weather the storm and even take advantage of opportunities that arise during a downturn. Remember, some of the greatest fortunes were made by those who had the resources and courage to invest when everyone else was running for the hills. But here is the thing, predicting the exact timing of a market crash is like trying to catch lightning in a bottle. The key is to be prepared, not paranoid. Stay informed, keep a level head, and don't let fear drive your financial decisions. As we wrap up this journey through financial crises past and potentially future, it's clear that the echoes of 2008 are still reverberating through our economy. The question isn't just whether we've learned from past mistakes, but whether we're prepared for the challenges that lie ahead. So, what do you think? Are we on the verge of another crash, or is all this talk of a 2026 meltdown just fear-mongering? Drop your thoughts in the comments below. After all, the more we discuss and debate these issues, the better equipped we'll be to face whatever the future holds. Remember, knowledge is power, especially when it comes to your financial future. Stay vigilant, stay informed, and most importantly, stay prepared. Because in the world of finance, the only constant is change. And who knows, maybe by understanding the lessons of 2008, we can work together to prevent 2026 from becoming another chapter in the history of financial disasters.